Good afternoon. My name is Bill Woodruff. I am posting live on a variety of social media channels for the first time. Bear with me a little bit as I navigate new systems and new tools. I will ease into it today to see if we might have some people to join on this live conversation. LinkedIn is really our primary, WealthFactor's primary source of disseminating information. Specifically, hope to have people join there. We'll be looking to the comments, if any, come through, and then trying to respond and engage with those proactively, specifically on LinkedIn. Before I get too far in, let me share a few words for compliance purposes. WealthFactor is a registered investment advisor, and compliance is an important part of the responsibilities associated with being an investment advisor. So this call is for informational purposes only and is being recorded. Statements made during this call are the opinions of myself and are subject to the risks and uncertainties, some of which are significant in scope and by their very nature outside of both my control as well as WealthFactor's. There can be no assurance that such statements will prove to be accurate, and actual results in future events could differ in a material way from said statements. Historical results are not necessarily indicative of future performance. A lot of those statements are pretty common across the industry, and often read or in the fine print for lots of my peers. We've built, in terms of introducing WealthFactor, before I get into the prepared comments, we've built WealthFactor differently and really approach our service universe with most of those things being true. I think that Wall Street and the media portray the primary reason why someone might utilize an investment service provider as having insights, special insights that might help somebody outperform the market or avoid declines and those sorts of things. And so we approach things very, very differently. And really, if you've participated in any of my prior calls or connected with me previously, you know that a lot of times I take the opposite approach in thinking about global financial markets and investing. And it's my opinion that if you're truly are an expert, you appreciate that from an investment perspective, that activities like picking and timing markets, whether that are stocks, sectors, markets, etc., aren't likely to yield long-term sustainable results. And so, at all levels, whether that's the investment management level, the investment advisor level, or the individual mandate. And so we approach our services with that philosophy in mind. So I will let me continue through. So just a little bit about WealthFactor. We are technically an investment advisor, as I mentioned. However, we've really over the last year or two pivoted pretty heavily to what I would define as wealth technology, and we have either built or are building technology designed for the head of a financial household whose wealth has become a bit more complicated than it makes sense to manage on their own. And it's my opinion that the average fully digital tool, or what the industry calls robo investment advisor, is really insufficient for navigating the wealth services needs of that particular person. I believe that the majority of the industry is built around a flawed model, which is one where there is a financial advisor at the center of the service universe, and they rely on technology built for them, and oftentimes a lot of outsourcing and layers. And so, with the advances in technologies just in the last several years, it's clear to me that WealthFactor has an enormous opportunity to make what has been a very inefficient way to get the wealth-related services and expertise that people need in efficient ways. And technology designed for this specific person or purpose there's an enormous opportunity here, and I'm really excited about it. So this is sort of a follow along to my statements around our investment approach or philosophy. Our investment services are built around our philosophy, which we call Risk Smart. And Risk Smart is rooted in evidence-based investing principles. And so the majority of what we do, it has a passive orientation and oftentimes mimics large, well-known asset managers that skew that way, such as Vanguard, dimensional funds, or perhaps Parametric as examples. It's my belief that technology has largely already made outsourcing investing for many parts, for the core parts of what ought to be the investment service deliverable, obsolete, and largely unnecessary. So let me jump into the sort of the purpose of the call today, which is to share an overview and some insights around the current environment and state of global financial markets, as well as our thoughts and how that applies to investing. And it's just to kind of share a bit of a spoiler in that regard. Our view is that this time always feels different. But rarely should it ever cause any deviation from a properly constructed investment plan. So let's start out by sort of looking at and thinking about the intermediate to long term. I think persistently it's the right way to approach thinking about investing in global financial markets. And so up until the last several weeks, we had been kind of hitting new all-time highs from a price and return perspective in most major U.S. indices, and so that idea it's really prevalent to see people look at that and assume that the market's due for some sort of correction. And I think it's just human bias and human nature in how we all think. But I think, and so whenever that's the case, I think it's really useful to go and look at data and say, does that our natural human tendency, does it actually play out in the data? If we think that, okay, we're at a new high, we should be concerned about a decline. Is that actually true? And there's lots of ways to manipulate and splice data, and so this is only one of countless ways in which you could try to answer that question. But the point isn't to try to gain insights for the purpose of making change, more for reaffirming the evidence-based approach to investing and the idea that we probably shouldn't be focused too much on the short term. So this analysis is going back to 1988, and basically what it's doing is looking at if you were to invest on a day where there's a new high over the next 1, 3, and 5 years versus any day. And so I think it's interesting to see that persistently on average, investing on days where you're hitting a new high, the actual forward-looking returns are better than just any random or every day in the sample set or data. So again, the point of all of this isn't to say it's a good time to be invested, but more so it's probably not, there's not enough reason to, just because prices are high, and the next several prepared slides I'll be sharing are valuation oriented, but just because valuations are high on a relative basis, that shouldn't necessarily drive us to deviate from our investment plan, assuming that investment plan is the right fit. So this particular graph is looking back to 96. It's the S&P, and the lines drawn on it are inflection points, kind of peaks and valleys. And then on there are PEs, forward-looking PEs. And so we can sort of get that's a normalizing measure, and to say, okay, price is one thing, percent change is another, and then let's look at that relative to the current forward-looking valuations, and we can see as of the end of the last quarter, forward-looking PEs for the S&P 500 are about 20, which on a historical basis, as we'll see in future slides, is above average. But isn't certainly outside of what we might have seen historically here in the U.S. There are non-U.S. examples where we've seen sustained PEs and peak PEs significantly higher than that. Again, just for perspective. So then the question is like, is valuation useful as a predictor? And of course, we can try to look at some sort of data to analyze that. And this graph, these two get a little bit complicated in its effectively a regression analysis. But the dots on the left all represent the forward-looking one-year returns based on different levels of PE. And you can see there, while there is a slight downward sloping line, which suggests some relationship between the forward-looking return and valuation, there are lots of outcomes that are very different than the idea that high PE necessarily leads to low return in the next 12 months. As you go out to subsequent 5 years, you do start to see a much tighter relationship between valuations and forward-looking returns. But again, I would focus on the idea that there's really, especially in the short run, very little predictive value in valuations. So as we start to then drill down a couple layers of detail into the dynamics of markets, looking at, and this is a natural function of market capitalization weighted indices and how they operate through momentum and cycles. But we are at a point where the concentration of the index for the S&P 500 is very, very high. So that's really the graph on the right here. It shows that 29% of a universe of 500 stocks in the S&P 500 are in just the top 10 largest positions. And so, just under 70% are allocated across 490 other companies. And so I think it's really important to acknowledge this current state of what might be driving the average PE of the S&P 500. It's being on an above average basis, driven by a more concentrated group of companies and their PEs versus the average concentration of the S&P 500. So this is the same concept, except for graphically showing the dispersion between companies with high PEs and low PEs across the S&P 500. So if you think about that universe of 500 stocks, the difference between those that are the lowest PEs and those that are the highest is quite large. Certainly not, both this graph and the last graph, it's not something that's outside of normal and historical expectation, but it's worth noting. It also suggests that probably that if you're concerned about valuation, there's plenty of opportunity through diversification beyond just the S&P 500 to reduce the average PE of a portfolio by just simply not being so concentrated in these very large names that are dominating current market capitalization weighted indices. So another, I'm going to intentionally avoid getting super detailed, but another thing that I think is interesting, and again, just like valuations, probably not super useful from a predictive perspective, but the looking at the historical returns by specifically the style. And this graph, this is a ton of data on this particular page. I'm just going to focus in on a couple parts. So first, I'll go to the right, and what the right is trying to do is put into perspective the relative valuation between value stocks and growth stocks. And you can see that changes very dramatically over time. And to kind of share some insights on this particular historical insights on this particular graph on the right, if you rewound to the late 90s as the tech bubble was building up, we saw valuation getting very cheap relative to growth. And then as the tech bubble burst and growth stocks declined dramatically, we started to see that unwind. And it took a full decade, really, through the financial crisis before it came to the opposite side of that spectrum or cycle, where, at least on this particular way of assessing it, growth became very, very cheap relative to value. And then as we think about our more recent history, which is it's easiest to get biased and focused on that over the last 10 years, we've seen that unwinding back in the other direction, where growth started out very cheap relative to value, and at least on this scale now is on the opposite end of that. And again, I can't emphasize enough, the point of this is not to suggest that now is a good time to be in value versus growth. The goal isn't to be predictive in any of this, but just simply to unpack and think about the dynamics of markets. And almost always, as I've distilled through these insights and this information, and just going through practical experiences of being faced with portfolio investment decisions, almost every time it leads back to the idea that deferring to the I don't know what's going to happen, and to being intentionally diversified is the best way to go, especially if the goal is to maximize the probability of preserving wealth. Certainly, if your goal is to outperform the market or accumulate wealth at any risk or any cost, certainly speculative activities probably, or making big bets, concentrated bets in one of the categories listed on the left, has a higher probability of higher returns, but also a much wider dispersion of probabilities of outcomes, including very negative or adverse ones. So it's been very easy for a lot of people, because of the momentum nature of the last several years, and the pandemic sort of accelerated some of that, to get comfortable with the idea that large growth companies, and this is overgeneralizing, but big technology companies are safe and going to outperform into perpetuity. There was a DFA, Dimensional Fund Advisors, it's almost 12 months old now, did a really nice piece that looked at big companies historically over full market cycles and sort of debunked that concept, saying that, in fact, the opposite's almost true. The largest companies tend to underperform the market on average on a going forward basis. So again, none of that's necessarily for the purpose of being predictive, but to support the idea that we should try not to be timing, picking, and generally trying to avoid concentrated risks, whether that be growth or value, small or large, and instead building very efficient portfolios diversified across all those sorts of risks and risk factors. This one is more for my own entertainment, really. I'm putting this one in here because it's the very short run, and we've seen some pretty fun dynamics in fluctuation just this year in growth and value. And there's lots of reasons for that. Part of it's that last graph I showed you, where perhaps you could make the case that value is cheap versus growth, and we're seeing a little bit of reversion there. The other thing too is that generally value stocks and dividend paying stocks are going to perform better, have historically performed better during periods of increasing inflation or rising interest rates. And we've started to see, especially, and that'll connect to the next page, but some increases in inflation, not so much in terms of rising interest rates, but certainly some indications of increased levels of inflation. But so if you're an investor and you don't think about your portfolio very often, and you're looking at value and growth over the last 12 months, it's been about the same. And I put the all market, and I'm using Vanguard ETFs just to keep it simple rather than indices. So it's that they're actually investable assets that we could potentially own. But for the 12-month period ending the end of last quarter, the total market, as represented by the all market index versus value versus growth, approximately the same. Year to date, very, very close again. But if you look at each individual quarter, we saw a very, very different story, where value did really well in the first quarter, and then growth dramatically outperformed value in the second quarter. Third quarter was kind of back to a wash again, but tilting back to the side of growth. So there's maybe a bit of a tug of war going on, and there's lots of complex dynamics. So again, I find this just to be kind of interesting along the themes of thinking about the dynamics of being exposed to both value-oriented companies as well as growth-oriented companies. And my general advice is to try to avoid an investment plan or a portfolio that's reliant on being able to pick when is a good time to be in one versus the other, and instead generally have exposure to both in diversified ways. Okay, so shifting gears now over to fixed income. Fixed income. I've spent a lot of time, and my background very much tilts to fixed income. And so, if you think about the name of the asset class, it has the word income in it. But the practical reality is, as this graph sort of shows with the blue or nominal yield, and this is the 10-year Treasury yield. So you actually have to, in order to get the yields that we're showing here, endure a fair amount of interest rate risk or a fair amount of risk in 10 years worth of Treasury maturity. So it's not, it certainly isn't necessarily risk-free like what we all feel in our checking or savings account, where there actually is very close to zero yield. But getting income in a portfolio from fixed income is really difficult and has been really difficult for a while. And so, really the purpose of fixed income to some degree sort of changes, in my opinion, and becomes, and it's always been this to some degree, but it's been a nice byproduct that it's also had yield or coupon that's been material, but that's changed in the last several years. But the primary role, in my opinion, for fixed income today is to create stability in the overall portfolio. And oftentimes I'm seeing, as we build personalized portfolios for our current customers and the customers we're bringing on, the newer ones, to the extent income is needed, to get it in fixed income, you're going to take a lot of risk, credit risk. And so we're generally saying, no, let's not do that. It's more efficient to take those similar types of risks in higher yielding stocks or dividend paying stocks and keep the integrity of fixed income in high quality. So this graph also shows the uptick in inflation. It's not actually graphically represented, other than it can be visually seen in the gap between the real yields, which are now substantially negative, and the current nominal yield for the 10-year Treasury at 1.5%. But effectively, the real yield is the nominal yield minus the amount of inflation, which is ticked up to approximately 4% here recently. So that concludes my prepared comments. I am still, as I mentioned at the beginning, a bit new to doing this in a live format. So I see I've got some attendees, and thank you for that. And I would welcome any comments or questions that you might have. And if I don't respond, that's user error. And please accept my apologies. Let's see here. I'm wandering around all my other screens to look and see if I can identify how to do this right. In any event, since the risk may be a little higher than I wish it were, that I won't be super reactive to questions you might have. I appreciate your time today and hope you enjoy the rest of your day. And to the extent that you have questions that you'd like to follow up with me on, and I don't get them answered in this live format, on this page is a good email address or our phone number as well. So please feel free to reach out, and happy to try to answer questions that you might have offline. I'm still searching, specifically in the LinkedIn Live elements, to see if there's something I'm missing. But as of right now, I'm assuming there are no comments or questions from this particular feed. So, please feel free to tune off. I'm going to stay on here just a bit longer in case I identify something that I've missed with some questions that got posted. Okay, I've exhausted my attempts to find comments, and so again, to everybody who participated, appreciate it, and hope you enjoy the rest of your day. Maybe I am getting a little message here. Right when I say that, I might get something. That's fun. Just a thank you message. Yeah, Renault, awesome. Thanks for participating. Enjoy your day.